Welcome, everybody. Merrill Chandler here, your host of the Fundability Report. So if you're just joining us or haven't joined us before, this is where we take a look at what's happening in the lender marketplace, the borrowing marketplace, the relationship between borrowers and lenders, and the ever-present inflation / recession that we're kind of in the middle of it, and how that affects your fundability. So the first thing we want to take a look at is, number one, the CFPB. Probably for almost 2 months straight, one of our articles, one of the things that we're reporting about is about the Consumer Financial Protection Bureau and moves it's making to improve the credit, the personal borrowing space, the credit space. Well, one of those, today we found out that the CFPB, Consumer Financial Protection Bureau, is actually suing big credit card issuers for suppressing, I'm quoting my air quotes, they're real quotes, suppressing credit data, right? Credit reporting data from some of the big banks. Let me name these: JP Morgan Chase, Citigroup, Bank of America, Capital One, Discover, and American Express. Conspicuously not mentioned here is Wells Fargo, probably because they've been under such duress on having their own problems. But what's happened is that the CFPB is accusing these 6 large banks of hurting their customers' credit profile by not reporting in toto all of the credit, the credit reporting data. Now, this has been going on in the report, going on since 2013, or they noticed in their study that it started around 2013. This is going to be coming. We will be following this trend as it unfolds, because we want to see that credit reporting data. Remember, lenders get to charge premium rates for lower credit scores. The lower your funding tier, if you've been through my boot camp or the consumer, our business funding master course, we learned there about the funding tiers, and the higher your score, the lower your rates, your interest rates, and the higher your funding approvals. Say $30,000 instead of a $5,000 approval. Well, these scores are artificial. These 6 banks are artificially suppressing or not including all of the data that would make the FICO score improve, which would then, of course, give better rates. And so, as this unfolds, we'll take a look at it. But very interesting. Also, here's fascinating. There's 2 pieces here that they're kind of related. Chesapeake Bank develops a system for instant virtual debit card issuance, meaning online applications are able to distribute an actual virtual debit card, similar to the Apple Pay, the Google Pay. But Chesapeake Bank is kind of on the front, on the leading edge here in the top 20 bank, or the top 40 banks, which are tier 1 and tier 2 banks. They have 1.3 billion in under asset management, but they're moving heavily online and creating online applications and online distribution of virtual debit cards. Now, this may not seem like a big deal, but what we call share of wallet is a big phrase, and a KPI, right? A key performance indicator for all banks and credit card issuers. The share of wallet means of the disposable income of a borrower. If they've got 3, 5, 7, 12 credit cards, who's being used? And so first in time, first in line is the principle behind what they're experiencing with at Chesapeake Bank. Because if we can get their argument is that if we can get a virtual debit card where they can do online transactions and over-the-phone transactions immediately upon opening a checking account there, then rather than waiting for the mailed-in plastic or other forms of that currently are being used in distributing a bona fide debit card with your name, and or for business credit cards, it would be the business names included on it, and the magnetic strip that carries all the information. All of that is being moved online. So it's a Visa branded. So Visa is the processor, and it is a point of sale, touch and click, grab your credit card, and touch it at the point of sale, or using it online. So we'll see what's happening here, but I believe more and more tier 1 and tier 2 banks, some community banks, some credit unions, but the tier 1 and tier 2 banks are trying to get in front of their customers as fast as possible and deliver access to their money as fast as possible. Online application, online deposits. So just like you take a picture with your phone and you make that deposit, the money is, to one degree or another, instantly available. And once it's instantly available, they want you to be able to spend it, and hence this digital debit card. Now, the next two issues are kind of, big banks are paying up for online deposits. And what's fascinating about this article is that there are banks who, just like we did here, online deposits. We just talked about Chesapeake Bank with the debit card, but three big banks are taking a page from the playbook of their online peers and paying attractive interest rates on digital savings account. So BMO Harris, Citibank, and PNC are what are being highlighted in this article. But what's important here is that they're trying to drive online deposits. So, of course, most of us are interested in cash over fundability, because most of us don't even know what fundability is unless you've been through the boot camp, unless you've been through our master course and you've been trained in one of our funding hackers. And so, because the rates are becoming more attractive, quarter point up to a half a point more than if you go to a local branch of a bank in town, right? And so now it's warranted because there's less overhead for an online account. But more importantly, if they can get more and more online deposits, then that's shifting the center of gravity from the Chases, Wells, Cities, et cetera of the world. That we're moving that center of gravity away from going into your local bank to making online deposits. Now, all the big banks have made it so that you can take a picture of and it's pretty easy to enroll in these programs. You take a picture of your check and it's deposited. So, but PNC, BMO Harris, and Citi, all tier 1 and tier 2 banks, are moving much faster towards incentivizing online savings, right? BMO Harris is 4.2% interest when going rates now are anywhere between 2.2 and 3%. So that's a 33% increase overall in over other of their peers who are doing savings accounts walking into the branch. So very interesting what's happening there. And the final thing I'd like to end on today is that, excuse me, retail banking is they're experimenting with innovative solutions to get more people into their branches. They're even calling them, it's hilarious, they even call them banking consulting centers. So the banks are moving, all of them want online deposits. They don't want clerks and tellers to take your deposits. They want to move away to more and more online deposits, right? And all debit, so there's few to no tellers in their perfect world, but everybody else, there's insurance and investments. And so all of a sudden it becomes a financial planning center rather than a bank where you make deposits. So watch for this. This is becoming a bigger and bigger. This shift is moving towards taking people's one-on-one time, right, face-to-face time, towards higher end uses in financial consulting, not the simple day-to-day of deposits and withdrawals. So we'll be following that as well. But this follows our trend that we've been doing for over a year about building holistic relationships between their customers, and financial wellness is our big play. Fundability and our fundability score is our movement into the financial wellness space. So we're grading an individual's likelihood of being approved, not a credit score. As we know, credit scores are used after the approval process to determine interest rate and amount of the approval. So how do we get in there? And all of this innovation is about how do we build financial relationships and nurture the financial relationships, and then make it easy on the customer doing these online deposits, and you're using your debit cards and credit cards remotely instead of in person in the branches. So lots of good stuff. Lots of good stuff. I love watching where everybody is moving, right? And interestingly enough, these new branch concepts, these financial consultancy centers, are literally giving the opportunity to cross-sell and go deep with a customer rather than because one of the stats that I've shared before, but is very relevant here. One of the FICO, David Smith told us at FICO that at the last FICO world we were at, that up to 60% of banks' depositors, Wells Fargo's depositors or Citi's depositors or BB&T's depositors, use credit instruments, do not have a credit instrument from Wells Fargo or Citibank, where their checking account is. Everybody gets credit instruments out there, car loans out there, mortgages out there, and only have checking accounts and or savings accounts locally. They want to cross-sell. They want to build this wide relationship with each one of their depositors. So more on that. In fact, some of the things that we're developing is how to support how we can support lenders, credit card issuers, et cetera, educate and build trust with their depositors and lead them perfectly without an application towards an approval, literally right there in their same bank, where the borrower education and the financial wellness program that we develop and we support lets them build deeper and better relationships. So we're all in this together as far as I'm concerned, and I'm looking forward to continually updating you guys on the progress of everything that we're doing. This is Merrill Chandler, your host of the Fundability Report. We will see you next Tuesday, 3:45 Mountain Time. Join us for all the exciting news that's going on.